Okay, for our practice exercises to finish out chapter 3, I am already in where basically we left off in our part 1 of this chapter, since we're breaking it into 2 parts. We left off with number 8, actually with number 7. We're going to come back and look at 7 and 8, or if it's just 8. But we're going to do number 9 first, and then we're going to go back and do the financial statements as well. And then we're going to do one combined problem that has everything. So the first thing here, none of the exercises in the practice do a real good job of the closing entries nearly as well as what we just did in our part 1, where we looked at closing out Dr. K. So this one, it only has us do closing out the revenue and expenses. So basically 2 of the 4 steps. So that's not as good, but we'll do as much as we can. So we've got here the account balances for net sales, the cost of sales, advertising, and other expenses. Okay, cost of sales, that is an expense, and that's an expense we're going to really look at starting next week when we start looking at inventory and selling inventory. But that is something that we do have to close out. All right, so we're going to close out just like how we did in our practice before. We're going to close out our revenue. Remember, revenue has a credit balance, so we're going to debit our revenue account here, and they call it, in this case, net sales, so we'll call it net sales. We're going to debit our net sales for the 549,780. We have to know that that is a credit balance. And if you open up your T accounts, you can be kind of refreshed that, oh yeah, revenues have a credit balance. And then we need to debit our income summary. Sorry, for our income summary for the 549,780. And then we go on to part 2. And all of our expenses all have debit balances. So we need to credit those. And we are going to debit our income summary. But if you remember from our practice, we don't really know what the income summary amount is going to be. So I'm going to temporarily leave that blank. And we'll come back and fill that in with the total once we're done with all these credits. So our first, we're going to credit to get rid of our cost of sales of $335,196. And then we had a advertising expense, so I'm going to go ahead and credit that. Advertising expense, $54,834. And finally, we had our last one, our other expense. With that amount of $117,907. Now we can easily go ahead and get our debit. Our debit has to be the total of all of these for our income summary debit. Easy. It's hard to do. We got 507,937. We've got everything. Let's go ahead and check our work, make sure we've put everything in right. Whoops, I didn't put that one in right. I said 507,937, but that's not what I typed. So let's change that. 507,937. Now let's check and make sure that looks right. There we go. Yep. We are good. Okay, now let's go back and number 8. We are going to use this to do number 8 and then number 10. I don't know why they skipped a number like that. But number 8 deals with the income statement and then also the retained earnings statement. And then number 10 finishes out the same problem by doing the balance sheet. So this is kind of a review, but it's going to kind of help us to see where the retained earnings numbers come from. as with our closing entries now, hopefully we've got a good feel for these. All right. So it says here the retained earnings balance is 155. Yep, that's where we're at, 155. So nothing really happened with the retained earnings throughout the year, which is common for most companies. Usually you don't affect your retained earnings, only doing that at the end. There are different times when you do, but for this one, it's just a very typical problem. Shows here that we've got dividends, so we're going to be closing those out. We're going to be closing out our fees earned and as well as our expenses. So let's get into this with the income statement. Hopefully we have a good idea and remember how to do this. Our revenue, we only have one revenue for this company, the trucking fees earned. So let's put that in here. Just put it in exactly as they have it, trucking fees earned. And then again, we don't need to put it in the subtotal since there's only one. We can just put it over in the total column of the 130,000. Come down to the expenses and we're going to just simply list. Looks like we have 4 expenses, so that won't take us too long. We've got depreciation and salaries expense. Depreciation. Expense. And our last 2 were office supplies and repair expense. Office supply expense and repair expense. Okay, we've got all of those forward. Now we just need to put in the amounts. 23,500, 61,000. So we put these over in the subtotal because we have more than one expense. So we want to total them all up together. 23,500, 61, all right. And then the last 2 are easy, 8 and 12. And it's good that they already have it totaling up for us, so that's nice. And then when our revenues are more than our expenses, we then simply call this net income. Net income of 25,500. Now, you might want to, I'm going to jot this down, 25,500, because that's going to carry over into our statement of retained earnings. Gotta go to part 2. Part 2, it's got our proper title all ready to go. Retained earnings at the beginning of the year, they told us that. Let's just get the amount. It was 155,000. Now we add in our net income. And that's where we simply get our number from last time, 25,500. And then we subtract out our dividends. And our dividends were 20,000. Now you won't put it in as a negative here. It tells you to put it in to subtract it out. So don't put it in as a negative like how I did on my Excel sheet. I do that to adding up purposes to make it so I don't forget to add it in. It's already set up here in this little formula. So just put it as less. So that's just 20,000. And our retained earnings, our new retained earnings, this is the other number we're going to write down because it's the second connector. So I'm going to write down 160,500. And that's the amount that we're going to use when we come over to number 10. All right, so for the assets, they have them broken down just like how we did way early on the first day. I broke them down. The problem didn't necessarily in the Connect. But here they're going to go ahead and have us break it down into current and non-current. So here we got our current assets. No cash without even looking has to be one of them. Every company has cash. 8,000. And I'm going to go ahead and put us over here. I usually have us put it over here in the subtotal, but that's okay. Accounts receivable. And then we had office supplies as our last current asset. So accounts receivable 17.5. Office supplies, make sure you put the supplies, that's what we still have left, not the expense, that's what we've used. Office supplies of 3,000. And as it says here, that's our total current assets. Now we're ready for our non-current assets, or if it doesn't like that, long-term assets. Or if it doesn't like that, we just got to figure out what it wants. Let's see what we got here for our options. Wants us to use plant assets. Just another terminology. I like using non-current. That's just my personal preference. Long-term assets also works. They call it plant assets. Okay. So plant assets, that's basically all of our long-term assets, and that's going to include our trucks, the accumulated depreciation. Those two go together. Remember, we talked about that with the adjusting entries. You combine them to get their book value, and then the land. Okay. So we're going to put up here, let's do our truck. And our truck was at 172. Now, right next to truck, everything, we put them together. We got our accumulated depreciation. So let's put that in here, 36,000. Notice it knows when you accumulated depreciation, we don't need to put it in as a negative because it knows that you're subtracting that accumulated depreciation to get your book value. So this is what the trucks still has left to depreciate. Remember, that's what we said that we are the book value means. It doesn't mean that's what it's worth. That's not the fair market value. And then finally, we had our last item, land. Land doesn't depreciate in accounting. It doesn't. It doesn't wear and tear unless you actually do something to it. So our land is 85,000, and that's what it's going to stay. We don't depreciate it. So 85,000. Adds those up, and then it combines in the total assets. So this 221 is the land and the book value of the truck. And then it takes the 221 plus the 28,500 current to get our total assets. And we come down to our liabilities. Just like with the assets, we break these down into current and non-current. So our current liabilities, ones that we're going to be using, paying off really soon. Accounts payable, that's one you usually pay off real soon. Interest payable is usually one you pay off real soon. And then long-term notes, that's pretty self-explanatory. That's going to be paid off over a long time. So we've got account payable and interest payable, 12 and 4,000 each. So we can put these in. Accounts payable, 12,000. And then we had interest payable, 4,000. Always have to go back and make sure I didn't read those wrong. Yep, 12 and 4. That's our total current liabilities. We come down here to our non-current long-term. Yep, that's what they want. Long-term liabilities. And they call it long-term notes payable. So that's what we'll use. Long-term note payable, 53,000. And that's all we had. We didn't have any more long-term, so there's nothing really to total. Add up our current plus our long-term, we get total liabilities of $69,000. Now we're ready for our last two items. The only two things we have left, if I look back up here, if I had this printed out, what I would be doing is checking off or Xing all of these that I have used, and knowing that I used all of these down here in my income statement and statement of retained earnings. I used the dividends, that's done. Revenue's done, expenses are done. Only thing I haven't used is the 20 grand for common stock, and I haven't used that new number. We wrote it down, 160,500 of my ending retained earnings. So that's going to be my only two things left: the 20,000 of common stock and my new retained earnings number. So I'll come down here and put in my common stock, 20,000. Then my retained earnings, this would be my most up-to-date number, the 160,500. Gives me my total equity. And then the final thing I always want to check, does my total liabilities and equity, 249.5, does it equal my total assets? And it does. So I can be rest assured that I probably have done everything correct. And it looks like I did. I got all check marks. Okay, the last thing, there's a few things that you can look up where I'm not going to necessarily hit these. A few things you can look up in Google for the couple ratio equations. Those are pretty easy once you just get the easy formula. There's a few more adjusting entries that you can work through. What I'm going to do, what I want to do to end this out is I want to do a kind of a combination on number 18. So with 18, it's kind of putting everything together. I think this will be a good way to finalize all of our steps in the accounting process. We're going to do the journal entry and T accounts for the normal stuff. Come down here and do the adjusting entries. And then that will get us into the adjusted trial balance, and then into the financials, and then the closing entries into the post-closing trial balance. This one doesn't actually have us do the closing entries, but we've got to know that they're actually being done kind of behind the scenes. They're not just gone. They don't just disappear. They are in effect. All right, let's go through all of these. I think this will be a good review for you to make sure you have all the steps, because in Accounting 101, you have to have these steps down. You have to know them pretty much by heart to do well in the rest of the class, as well as in Accounting 102. And then if you go in further, you got to know these basics. All right, so let's just get into it. Let's ready to go into our general journal. Number one, and I think as we'll see, I think these go into the T account for us, but if not, that's fine. We can go ahead and put them in. We invested $30,000 cash into the business, and we also invested computer equipment, 20 grand, in exchange for common stock. So remember the questions: what did the company get? We got these two things. How did they get it? They got it from the owner. So we're increasing the owner's balance in the account by giving them common stock. So we record the entry. Now let's see if it went into the general ledger. Yep, it went ahead and put us in there for us, so we don't have to update our T account as we go. And it's also going to be updating our trial balance as we go, it looks like, as well. So it's taking a lot of the steps and doing it for us, which is nice. All right, number two. The company rented furnished office space by paying $1,800 cash for the first month of rent. So we're getting the benefit now in April, and we're only getting it now. It's not for the next couple of years. So we can do this just as a normal rent expense. So rent expense, $1,800. Let's make sure they don't have some other expense that they want us to use, but I'm thinking that's the one. Yep, I don't see any other like furniture rental or anything like that. So that's the one we should use. We'll come back over here and it says how did we get the rent? We paid it with cash. So credit our $1,800. All right, we purchased office supplies. We record everything that we haven't used, and then we will, just like we have been, so we're not going to call it an expense right away. I'm going to put it in as an office supply for $1,000. And then it says we bought it with cash, so credit $1,000. Hopefully, as you're going through these and doing these on your own, I would have a split screen set up so you can see what I'm doing, and then you do the similar on your own. That's the best way to learn. And then hit pause. If I go a little too fast, you can easily hit pause. But for some of you are able to keep up, I'm gonna keep going. The company paid $2,400 cash for a 12-month insurance policy. The company's policy is to record all of it as a prepaid. Okay, so we'll go and do the prepaid insurance, $2,400, and we pay for it. So credit our cash, $2,400. Sometimes it's a good idea. You might want to just check your work, see how you're doing. So we can easily do that. We've got our first three, our first 4 entries done. We're ready for transaction number 5. Company paid $1,600 for 2 weeks salary. So make sure we call this what they call it, salaries. And this is an expense because we've actually paid it and they have earned it. So we don't want to call it payable because we actually have paid it. Cash for $1,600. Record the entry. Okay, now we're actually getting money. It says we have actually started making money. We collected $8,000 cash. And this was on commissions from airline. So we're going to call it what they call it, commissions earned, $8,000. And that's just like anything else, fees earned, service revenue. This is a revenue account. Company paid $1,600 for 2 weeks salaries. Oh, more salaries. Okay, so salary expense, $1,600. And credit our cash, $1,600. Company paid $350 for minor repairs to the company's computer. So since they call it minor, and that's a key, as we'll see later on in the semester, when it's just something like an ordinary repair, we can call it an expense. But if it was something big, like they put in a new hard drive into the computers, then we would actually have to debit our computer account and depreciate it. But since this is just minor, we can go ahead and call it a repair expense. Because it's just a normal wear and tear. I think of it like getting an oil change on a car. That's not something that really makes the car different. It doesn't make it improve it. It just is a normal thing you have to do to keep it in working condition. We paid $750 for this month's telephone bill. So we'll see if they call it telephone. Yep, you could call it utilities. Some people do. Cash, $750. Record the entry. Looks like we paid dividends. We must be getting towards the end of the year or the end of the month. Dividends, $1,500, and it says they were paid. So credit our cash. All right, looks like now we have moved on to the adjusting entries. Yeah, we've done all of those. We've done all of the April entries. We're ready for A, B, C, D, E. 2/3 or 133 of 1 month's insurance has expired. Okay, so we have used the insurance. So it goes back to our previous part one. What did we get? We got the benefit of insurance. So we call that insurance expense for $133. And where'd it come from? Well, we didn't actually pay it this time. We paid it a while ago. Where it came from was our prepaid account. Prepaid insurance for $133. At month end, $600 of supplies are still available. Well, I could look at my trial balance to see how much supplies I have, and it's probably the best way to do it. But I could also come back up here, since this is a brand new company, and I bought 1,000 of office supplies. It tells me if I had 1,000 and 600 are still available, well, that means I used 400. And so if I used it, I call it an office supply expense. Of the 1,000 that I had, less the 600 I still have, so that means I used 400. And where'd they come from? They came from my office supply. It's like your office supply closet. This month's depreciation on the computer, we don't even have to figure it up. Remember in our examples, we did straight line depreciation and we figured it up. But they go ahead and just give it to us. So this month's depreciation on the computer is 500. So we're going to do a depreciation expense. 500. And then remember the credit every single time with a depreciation expense is accumulated depreciation. That's a contra account, a contra asset. Employees earned $420 of unpaid and unrecorded salaries as of the month end. Okay, so we need to show that they do have salaries that they have earned. They've earned $420, but instead of crediting cash, we don't want to do that. We want to credit our salaries payable. Salaries payable because we haven't paid them and we owe them the money at the end of the year or the end of the month in this case. So going into May, I will begin to pay them the $420. I believe this is our last, yep, this is our last adjusting entry. The company earned $1,750 of commissions that are not yet billed at the month end. So we have actually earned them. We've done the work. They have promised to pay us. So remember, we call that accounts receivable, $1,750. And why do they owe me money? Well, it's because I provided them a service and I get to record commissions earned. Same thing as service revenue or any other type of revenue. Okay, good. Oh, this one does have us do closing entries. I'm glad it does. But before we do that, let's stop and let's take a look at everything. Let's look at our trial balance. Where we're at, we've got all of our assets and then our contra asset over here. We've only got, looks like one liability, our salaries payable, our common stock, and then our dividends, our revenue account, and all of our expenses. The debits equal our credits, so we're in good shape. The income statement, let's go ahead and do this. I think it kind of makes sense that we go ahead and do the income statement before we do our closing entries. Because once they're closed, then you might think, well, there's nothing left to go on the income statement. All right, so our revenue, we have our commissions, and oh, that's nice. It brings over whatever the balance is in the commission account. It just wants to know, do you know what goes in here? And that's the only thing that goes in here. So one thing you may want to do, and I don't know if there's the ability to print just this page. I'm afraid to mess it up. That'd be a lot of printing. I don't know if there's a way to do that. You could the best way probably is just to do a print screen. Have this up and then print screen, put it into a Word document. And maybe I'll just do that so you can see what I mean. Let's do a print screen, pull up a new document. And this will help us if you're still kind of unsure of, that's not as good as I was wanting. This is just a picture, but you could go ahead and just actually print this, print off this little picture, and then go through and X out. It's hard, you can't really do it on a picture very well. We can, I think we could edit it, but I'm not going to do that. But that could really help you if you're unsure of when account you've already used. I'm going to go ahead and get rid of this. Okay, so let's just go through and we'll just have to remember what accounts. So the first two we have, remember we're doing the income statement. We've now are ready to do our depreciation expense and our salaries expense. So depreciation, not that one. Depreciation expense and our salaries expense. Okay. Our next two, insurance and rent. Insurance expense. Expense. We only have a couple left. Office supplies, repairs, and telephone. So, office supply expense. Repair expense. And telephone expense. So it's taking our total revenues, subtracting out all of the expenses. We've got a net income of $21.97. You can flip back or you can just try to remember that number or write it down like we did in our practice. So I'm going to write down $21.97 because that's going to be the amount we're going to use. When we come over here to our statement of retained earnings. Oh, it's already got it all filled in for us. All we've got to do is put in, looks like the beginning amount. So let's go back to our trial balance. Oh, this is a new company. I forgot about that. New company. So we don't have any retained earnings. There's nothing to even put in. Retained earnings is 0 to start because it's a brand new company. We didn't have anything flowing over from prior months or years. It put in the net income of $21.97, so that was nice. It put in the dividends. I'm surprised it put in that. I'm surprised it didn't have us put that in. And then our ending retained earnings of $6.97. Well, let's see if it puts that in. No. Okay, so that one we will want to write down. $6.97 is our ending retained earnings. So we're going to use that when we go to the balance sheet. All right, our current assets. It's going to be definitely cash. Usually there's accounts receivable. Let's see what we have. Trial balance. Yep, cash, accounts receivable, and then office supplies and prepaid insurance. But we can come back and get those. So cash and account receivable first. Cash. I like it that it puts the numbers there for us. Accounts receivable. And then we had office supplies and prepaid insurance. Office supplies and prepaid insurance. So that's our total current assets. Because when we get down to the next one, it's a long-term asset. These two here are long-term in our property, plant, and equipment. So my computer and then the accumulated depreciation of the computer. computer, and then the accumulated depreciation of our computer. So that takes it away, tells us how much we still have left to depreciate. And then when you add in the total plus our total current assets, that's where we get our total assets. Now we're ready for our liabilities. We only have one or two. Just the one, salaries payable. And then we go right into our common stock. So current liabilities, all we had is salaries payable. That's it. That is our total liabilities. We come down and now we're at our last two accounts, our common stock and our retained earnings, our ending retained earnings. Oh, and it remembered it for us. 697, that is correct. That is what it should be. And then our check figure, do our total assets equal our total liabilities and owner's equity? And they do. Now, what I want to do is I'm almost ready to do the post-closing. But before I do that, I'm going to go back to I'm ready to do the closing entries. So let's view the transaction list. Go all the way down to number 16. We're ready to close out our revenue accounts. This one, I believe, will have us close all 4 steps, so that's good. All right. We're going to close out our revenue balance. Now, I don't think it's going to just put it in there, so we're going to need to go to our trial balance and see what our revenue is. Our revenue is $97.50. Okay, let's come down. Yep, we're going to need to put a new one in. Come on. 97.50, about forgot the number. Okay, we're ready for 16. Revenue. Remember, that has a credit balance. So we're going to want to debit our commissions for the $97.50. And then put in our income summary as a credit for $97.50. And record that entry. I'm going to go ahead and I know that all of my expenses are going to be credited because right now they have debit balance. So I'm going to debit my income summary, and that's going to also make this so I think I can come back to it pretty quickly. Because now what I'm going to want to do, and this is probably the most tedious part. Let's see. Save it. Oh, okay. This is probably where I'm going to want to write these down so I don't have to keep coming back to this sheet. Maybe I'll just make another print screen of it, and this one I'll go ahead and just keep. I don't want to have to keep coming back and then that gets old. So I'm going to print screen this and then make it bigger so I can read it. This is going to help speed up our closing entries. Let's gotta go. Let's move this over. All right, now let's go back to our journal entries. Transaction list, and we are ready for the expense. April 30th. All right, it didn't save the income summary, that's fine. So we've got all of these debits in the expenses. So we're going to need to credit them, and we're going to credit them to income summary. Now, technically, I don't know what it is, my debit, until I go through and add up all the credits. So let's go ahead and put in all of our credits. This would be we've got our depreciation expense. this down so I can see it. Depreciation expense, we're going to credit for 500. And then we've got our salaries expense. And we credit that for the 3620, I believe that's what it is. Yep. Then we've got our insurance expense. 3. Rent expense for 1800. More office supply expense. We need to get rid of that with a credit of 400. Our expense. 350. And finally, our telephone expense. For 750. We need to add all of these up. And that was already done for us in the income statement, but I'm not gonna revert back there. I'm afraid it's gonna get rid of all of these that I just did. So I'm just gonna add them up here in my calculator. $7,553. And record that. And now at this point, I can go ahead and check. I'm going to go ahead and check my income statement and see if that's what the total expenses it had. That's a good thing to do at this point. The income statement, let's verify its total expenses. Oh my goodness, it didn't keep them. On yours it will. I think it's because it switched pages on me somehow. It tells me up here that when I'm in student mode, it's the assignment data is not going to be saved. I don't know what I clicked on to make it not save, but yours should save. That's just unfortunate for us right now. But let's just go ahead and finish out our general journal. We've got let's look at the trial balance. You can see everything has now been closed out. Our trial balance and has the income summary instead of all of the revenue and expenses. We only have 2 things left to do. We need to get rid of our income summary and our dividends. So we need to get rid of these 2 items. So I'm gonna jot these down instead of doing another print screen. I had income summary of $21.97 and I have dividends at $1,500. So now let's get rid of those. And this one, then we'll go to the final step, that post-closing, and answer the couple questions there. So we go back to our general journal. We're ready for the last 2 items. 18. Closing out income summary. Right now, income summary has a credit balance. Remember, it had a credit balance of $21.97. So as a debit to get rid of it. Credit my retained earnings, $21.97. That's how I get rid of the income summary. That's step 3. And finally, I just need to get rid of my dividends. My dividends have a debit balance, so I need to credit them. So then to offset it, I debit my retained earnings for the $1,500 that I wrote down off to the side. So now once I record this entry, I look at my trial balance. It's not going to have any revenue, any expenses, or any dividends, or any income summary. Everything has been funneled into this one account in retained earnings. And 697, that number rings a bell. I remember that being my ending retained earnings for the balance sheet. So that tells me I did everything correctly. Now we go to the post-closing. The post-closing says, okay, should this account be here? And remember, all of these are going to be yeses until we get to our retained earnings, basically. So is cash? Yep. And it go ahead and puts the balance in. Is our account receivable still here? Yeah. All of our assets are still going to be here. Our computer, that's an asset, and as well as the accumulated depreciation, it is a contra, but it's still an asset. The liabilities are still here. Common stock is still here. Retained earnings is still here. Everything else is gone. The only thing I don't see on here is the dividends. I don't know why they didn't include the dividends, but these would be no. Nope. All my revenue and expenses are temporary accounts. They go away at the end of the year. They funnel into retained earnings. No, and no. At this point, I could go ahead and check my work. Post-closing trial balance looks good. Could go into my general journal, and everything there looks good too. All right, hopefully you've got a good feel for the main foundation of accounting. Everything else we do in accounting from here on out is just going to expand on these items. So you've got to have these down, and I hope you do after this. Let me know if you don't, if you want to go through anything kind of more on a 101, if you want to go through some of my own pre-made examples where we do them in Excel, or if you want to do something in Connect. Just let me know, and I'll be glad to work with you. All right, that's going to end it for here. I will see everybody next week when we look at selling inventory.